The phones kept ringing. By Sunday evening, a 158-year-old institution was hours from failure. Across New York and London, balance sheets were being recalculated, credit lines reassessed, collateral values revised downward in real time. It was September 2008, and stability had already begun to fracture. Lehman Brothers had spent the previous year adapting to a market that no longer behaved as expected. Mortgage-backed securities that once traded with deep liquidity had become difficult to price. Repo funding, previously routine, required increasing collateral. Haircuts widened. Counterparties grew selective. Inside the firm's headquarters on 7th Avenue, the numbers still suggested survivability. Reported assets approached $600 billion. Capital ratios, while pressured, remained within regulatory boundaries. Risk models projected losses but not extinction. The firm continued to operate. What mattered was less visible. Short-term funding had become the firm's circulatory system. Each morning required fresh borrowing. Each afternoon depended on renewed confidence. The mechanics were technical but unforgiving. Securities were pledged. Cash was received. Positions rolled forward. By early September, those mechanics were slowing. Credit default swap spreads widened sharply. Equity prices fell in accelerating increments. On trading floors, screens displayed familiar symbols beside unfamiliar volatility. Price movements became steeper, pauses shorter. Liquidity thinned without announcement. At the Federal Reserve, the concern was systemic rather than singular. The collapse of Bear Stearns 6 months earlier had demonstrated the speed with which funding pressures could propagate. That intervention had relied on an acquiring institution willing to absorb assets under extraordinary support. Lehman presented a different configuration. Unlike its predecessor, the firm lacked an immediately viable buyer. Its asset composition was more opaque. Valuations varied across models. Potential acquirers requested guarantees that exceeded political tolerance. The arithmetic of rescue had grown more complex. The week preceding the failure unfolded in narrowing intervals. On Wednesday, equity markets registered renewed declines. The firm's stock price, once measured in tens of dollars, traded near single digits. Analysts revised expectations downward. Rating agencies issued statements framed in conditional language. Confidence did not collapse all at once. It eroded through adjustments. Repo lenders increased haircuts. Collateral eligibility tightened. Funding desks recalibrated assumptions once considered stable. Liquidity buffers designed for stress were consumed by persistence rather than shock. By Friday morning, the urgency had become operational. Senior executives, regulators, and potential acquirers converged at the New York Federal Reserve. Meetings proceeded without theatricality. Documents circulated. Term sheets were reviewed. Asset pools were discussed in aggregates and exclusions. Two names dominated the room's calculations: Barclays and Bank of America. Both institutions examined acquisition structures. Both assessed exposures. Both required varying degrees of loss protection. The negotiations were technical, iterative, constrained by time and statute rather than preference. What happened next would compress years of precedent into a single weekend. For regulators, the constraints were explicit. The Federal Reserve's lending authority required collateral deemed sufficient. The Treasury's capacity for direct capital support remained politically contested. Legal frameworks defined the perimeter of possible action. Alternatives narrowed through definition rather than rejection. By Saturday afternoon, discussions centered on asset guarantees. Potential acquirers requested backstops measured in tens of billions. Loss projections varied. Valuation disagreements persisted. Market conditions continued to deteriorate outside the building. In London, a parallel constraint emerged. Barclays required shareholder approval under United Kingdom rules to finalize an acquisition involving substantial commitments. The procedural timeline exceeded the available hours. Regulatory compatibility became as decisive as financial logic. Inside Lehman, liquidity projections shortened further. Cash balances were updated. Funding maturities were mapped against shrinking availability. Treasury desks monitored inflows measured against outflows already scheduled. The calculations became hourly rather than daily. By Sunday morning, one negotiation had shifted course. Bank of America redirected its attention toward Merrill Lynch. The acquisition offered a clearer asset profile, a more predictable capital requirement, a resolution pathway aligned with institutional priorities. Discussions accelerated. The absence of a buyer altered the decision landscape. Without an acquiring institution, the framework reverted to statutory boundaries. Emergency lending without sufficient collateral presented legal complications. Direct guarantees without congressional authorization posed political risks. By late Sunday, the outcome had stabilized into inevitability. Lehman Brothers prepared its bankruptcy filing. Legal teams finalized documentation. Balance sheets were assembled for disclosure. Counterparties adjusted exposures in anticipation rather than surprise. At 1:45 a.m. on September 15, 2008, the filing was completed. Reported assets totaled approximately $639 billion. Liabilities exceeded $610 billion. The scale established the largest bankruptcy in United States history. The announcement arrived not as spectacle, but as procedure. Market reactions began before opening bells. In Asia, equity indices declined sharply. Funding markets tightened. Credit spreads widened across sectors previously considered insulated. Screens displayed synchronized red across geographies separated by hours but linked by exposure. On trading floors, the mechanics resumed under altered assumptions. Positions referencing Lehman required replacement or closure. Collateral arrangements were reassessed. Derivative contracts triggered termination provisions. Clearinghouses recalculated margin requirements. The initial losses were significant. The secondary effects were larger. Money market funds registered impairments. Interbank lending contracted. Liquidity hoarding intensified. Institutions previously categorized as counterparties became potential sources of instability. Regulatory responses unfolded in rapid succession. The Federal Reserve expanded liquidity facilities. The Treasury introduced capital support mechanisms. Deposit guarantees were adjusted. Policy instruments once theoretical were operationalized within days. Each action addressed propagation rather than origin. The bankruptcy did not represent an isolated event. It functioned as a transmission node. Asset prices, funding conditions, and confidence measures recalibrated simultaneously, revealing interdependencies previously abstract. In the weeks that followed, institutional language shifted. Stability became the organizing principle. Capital injections were framed as buffers. Liquidity programs were presented as bridges. Balance sheet expansions were described as temporary accommodations. The system adjusted through scale. Central bank balance sheets expanded by hundreds of billions. Emergency programs proliferated. Private losses became intertwined with public interventions. Market functioning gradually stabilized, though at altered baselines. Later narratives would simplify the sequence. Some accounts emphasized individual decisions. Others highlighted regulatory philosophies. Many described the weekend as a binary choice between rescue and collapse. The operational texture receded behind interpretation. What remained less visible were structural dynamics. Lehman Brothers operated within funding architectures dependent on continuous market confidence. Asset valuations relied on liquidity conditions susceptible to abrupt withdrawal. Regulatory tools were bounded by legal definitions resistant to improvisation. No single variable dictated the outcome. Liquidity pressures interacted with valuation uncertainty. Legal constraints intersected with political feasibility. Institutional incentives aligned locally while diverging systemically. The collapse emerged from accumulation rather than rupture. The firm's immediate aftermath was procedural. Assets entered bankruptcy administration. Claims were prioritized. Counterparties negotiated recoveries. Trading operations ceased. Employees exited buildings carrying personal items beneath cameras that arrived after decisions had concluded. The broader system recalibrated. Capital requirements increased. Liquidity buffers expanded. Stress testing became institutionalized. Resolution planning evolved from concept to mandate. Funding models shifted toward longer maturities and diversified sources. 5 years later, the architecture appeared more resilient. Yet resilience carried its own transformations. Market-making activities migrated. Risk concentrations shifted. Regulatory perimeters expanded. Balance sheets reflected adjustments shaped by memory rather than forecast. The institution itself did not survive. Lehman Brothers was dismantled through legal process. Its assets dispersed. Its name persisted primarily within financial history and regulatory discourse. The markets it once navigated continued without it. The system endured, as financial systems often do. What remained unsettled was not responsibility, but comprehension. Complex institutions operate through mechanisms that function smoothly under stability and strain abruptly under doubt. Funding, valuation, and confidence form feedback loops resistant to linear explanation. In September 2008, those loops tightened simultaneously. The bankruptcy filing closed one balance sheet. The policy responses stabilized others. Market functioning gradually resumed. But the underlying structural tension persisted. How financial systems organized around continuous liquidity accommodate moments when liquidity itself becomes conditional.